Well, good morning, everybody, and welcome back again to Strongman Personal Finance. We have an awesome reaction video today. It is a video made by none other than Ben Felix, who is a financial advisor up in Canada, but I give him a little bit of an allowance. I don't roast him as much because he does make pretty good videos and he does have some good points. In this video that we're going to react to, Ben Felix exposes the stock market ETF slop scam that is going on, where all these different companies launch every possible ETF you can possibly imagine in order to make as much money and fees as they possibly can from gambling degenerates. ETFs have gone absolutely bananas. There are way too many ETFs. We don't need this many ETFs. And the concept that an ETF is a diversified, sensible investment no longer applies because of the amount of slop and garbage that has been pumped out there by all these disgusting capitalist scum companies. So let's go ahead and react to old Benny Boy. We got a decent video here. It's The Rise of ETF Slop by Ben Felix, published 10 days ago, but it's got a decent amount of views, 270,000 views. And for good reason. This actually gives me hope, okay? At least some people are not so stupid that they actually get some good advice and hopefully understand what Ben Felix is trying to say here. All right, let's watch.
ETFs are no longer synonymous with sensible investing. The fund management industry is launching hundreds of new actively managed ETFs every year, and for the first time in US market history, there are more ETFs than there are individual stocks, and there are more actively managed ETFs than there are index tracking ETFs.
Yes, these disgusting scum on Wall Street, and they are disgusting scum. They're here to make money from you. That's it. They are thinking they're trying to develop any possible product they can to convince you to buy their garbage so they can charge fees on it. Go look at Yieldmax. What do you think Yieldmax is? It's an illusion. It's a trick. It's a deception. It's fake passive income. But Yieldmax, by creating these new ETFs and deceiving people with fake income, is able to make a fortune off gullible retail investors. It's disgusting.
Many of the ETFs being launched today have been engineered clearly to attract assets rather than to improve outcomes for investors. I think what we are seeing is best described as ETF slop. I'm Ben Felix, Chief Investment Officer at PWL Capital, and I'm going to tell you why ETF slop is making it harder for investors to make good long-term decisions and bringing us right back to the dark ages of investing.
Yes, that's what the grifters on Wall Street want. They want you confused. They're all trying to confuse you. Because if you get confused, you don't know what's going on, you look to a higher authority. And of course, they're the higher authority. So they're the experts. So you got to pay them to help manage your portfolio because it's so complicated. It is such an obvious grift, and basically everybody falls for it. But I'm the idiot with VT. Yep, I've heard this 1,000 times.
"2025 was a big year for ETFs. In the US market, more than 1,000 new ETFs were launched, and the majority of those fund launches were actively managed. That is a record for new fund launches in a year. Here in Canada, we had more than 300 new ETFs launch, again, with the majority being actively managed. Not only are many of these funds actively managed, but they're employing complex strategies that I think are unlikely to be beneficial for most investors most of the time. While low fees have been a big part of the success of ETFs, with many index ETFs having fees below 0.1%, the average management fee for US listed ETFs launched in 2025 was more than 0.7%. And 160.
These people are so disgusting. This is why I was only a financial advisor for like 2 months. I didn't even know what I was getting myself into. It's nothing but greed and evil. Wall Street is not good. If you want to work on Wall Street, you're kind of a scumbag, okay? You just want to make money. You don't care if you scam, steal, lie. As long as you make money, that's all that matters. You people are sick in the head. You people are demented. If that's capitalism, I don't want it.
6 of the newly launched funds have a management fee above 1%. Index ETFs showed investors the light. You do not need to pay high fees for actively managed mutual funds that trail the market. That caused real change, with investors ditching their high fee actively managed funds.
And, Jack Bogle was right about ETFs. I think I remember reading that Jack was concerned that ETFs would create more churn in people's portfolios because people would be more tempted to trade them because they're actively traded throughout the day. And look what happened. Now we have 1 trillion ETFs all out there, all charging management fees and enriching those disgusting, psychopathic, scamming filth bags at Wall Street. This is gross. This is totally disgusting. Okay. I mean, at least index ETFs have kind of, they've still kind of taken the majority of the ETF space. But you can see that actively managed equity ETFs, they're starting to grow. They're starting to slowly build more momentum there. I dread seeing if these charts ever match to where actively managed ETFs match index equity ETFs. I will be very upset when that day comes. And if the clown bubble doesn't pop, we could get there.
Funds for low-cost index ETFs. This new wave of high-fee ETFs is bringing us right back toward darkness. Let me back up. ETF stands for Exchange Traded Fund. That is a fund that trades on a stock exchange like a stock. The first ETF was created here in Canada, and it was an index ETF tracking Canadian large-cap stocks.
I didn't know that. That's interesting.
An ETF is just a wrapper that can hold an investment strategy inside of it, making it easy to get exposure to that strategy by investing in units of the fund. For example, it's much easier to buy an S&P 500 ETF than it is to buy all of the stocks in the S&P 500 index and make the necessary trades to match changes in the index over time. Think of it like buying a pre-made fruit salad instead of shopping for washing and chopping 500 different fruits yourself. I don't even know if there are 500 fruits. While index funds were the first use of the ETF structure, ETFs can hold pretty much any investment strategy. Even complex strategies using leveraged derivatives or both can be packaged up into an ETF. This makes these complex strategies really easy to buy for anyone with a discount brokerage account. Index ETFs have been...
Oh, thank you, Robinhood, so much. I thank you so much for making it so easy for these morons to buy this absolute slop. They democratize investing, low fees, total market exposure. No, it wasn't that. No, it was Robinhood, bro. So now I can sports gamble on the app. That's democracy, bro. Well, let's get rid of democracy too. Why don't we?
Wildly successful. They swallowed a ton of the assets that used to sit for investors, but their low fees and the market's domination by huge firms like Vanguard and BlackRock mean that if you want to get into the ETF business, you're not going to launch another S&P 500 index fund. In both Canada and the US, a combination of regulatory rule changes, regulatory approvals, and product successes has led to the rapid proliferation of ETFs for all kinds of investment strategies.
You mean deregulation helped create this absolute explosion in nonsense ETFs? I thought all regulation was bad, bro. How dare we regulate the free market, bro? Now we got 10x inverse leverage Dogecoin ETF, bro. That's the free market capitalism, bro. Now we have Yieldmax. Oh my God.
Designed to appeal to investors who want more than an index fund. While more product choice might sound good, this type of innovation has a long history of driving profits for the innovative financial firms, often at the expense of the end investor.
Really? You don't say? Wow. But of course, all the comments will be defending all the slop. That's how clown world works. People are fanatically loyal to the people that scam them. Somebody that tries to show them the truth, they hate. They revile them. They attack them. They defame them. But the person that's scamming them, they worship them. Oh, yes, scam me harder, please. Oh, I love it. Bend me over and scam me to death. Oh. People are sadistic and insane.
The innovation we are seeing now, in my opinion, is best described as slop. Slop has come to mean digital content of locals of artificial intelligence.
Oh, I thought that was defining me, but then I don't use artificial intelligence, so I was good.
I think we're seeing something similar with ETFs, huge numbers of complex, high-fee products that are likely to make investors worse off rather than better. The huge growth in ETF slop makes it harder for investors to find good information and choose sensible, low-cost investments for their long-term goals.
It's so hard, bro. What do I choose? I don't know. Is there one ETF that could give me global equity exposure? No, I can't do that. That's just too simple. I need to be more complicated. I need my 10x inverse leverage Dogecoin ETF, and I need my 2x inverse leverage silver ETF during a massive bubble. And I need Yieldmax for passive income, bro. You're a clown. I'm the smart one. You're the clown. Fact.
It's like trying to find a good book in a library where someone dumped 10,000 trashy novels on top of all the classics. The good stuff is still there, but now it's increasingly buried under piles of junk. I'm going to talk about 4 product categories that fit into my definition of ETF slop and explain why most investors should probably avoid them. The categories are thematic ETFs, buffer ETFs in 2025, a huge portion were leveraged ETFs, derivative income ETFs, and defined outcome or buffer ETFs.
Gil is seething right now. I'm not buying slop. I'm a sophisticated investor with my 2x inverse leverage silver chart.
27% of the new ETFs were single stock ETFs. Derivative income ETFs took in the most flows. Okay, let's get to the slop. Again, I'm going to go through thematic ETFs, buffer ETFs, covered call ETFs, and single stock ETFs. Thematic ETFs are funds that focus on specific trends in the economy. A big theme in 2025 was AI, but past examples include themes like metaverse, crypto, clean energy, electric vehicles, and cannabis. Thematic ETFs capture the imaginations of investors. Imagine how rich you will be if you invest in the next big thing.
I'm a smart investor. Everybody's in AI. So now that everybody else is in AI, I'm going to get into AI. I am a genius. I am smart. Look at that past performance. Buy my course, bro. Moron.
Before everyone else realizes how big it's going to be. The problem is that thematic ETFs tend to launch after the theme they represent has delivered high returns, when investor interest is high, and then goes on to deliver poor performance, often resulting in the fund closing down. Research Commission.
Really? You mean stuff gets popular after it goes up a lot? I could have never imagined that. People buy stuff that went up a lot and then act like they're geniuses. I'm so sophisticated. I'm so smart. I should get a PhD in investing because I look at the past performance. I see what went up a lot and then I buy it. Yes, I'm so smart. Gosh. People are so stupid.
By the Financial Times shows that the vast majority of thematic exchange traded funds, which enjoyed a surge in popularity in 2025, have underperformed broad market benchmarks. A 2021 academic study found that thematic ETFs underperformed by 6% per year on average in the 5 years after launching, even though their themes have strong performance before launch.
Wow, really? I would never have imagined that.
Before thematic ETF launches, the stocks in the theme have usually been rising in price and getting positive media attention. After the ETF launches, stock prices tend to fall back to normal levels and media attention tends to decline.
I live in clown world. I'm still trying to cope with it. I live in clown world. Nothing makes sense. Everything is upside down. What has happened to my country? What has happened to this world? Why are we all so insane and low IQ now?
The data in this paper suggests that thematic ETFs launch based on themes where investors are too optimistic and interested. ETF companies like to launch these funds because they can charge higher fees, and investors are eager to buy them because they're excited about the theme. Unfortunately, reality doesn't match those excited expectations. Morningstar's Global Thematic Fund Landscape 2025 finds that the long-term odds of picking a thematic fund that both survives and outperforms global equities is very low. This chart from Morningstar's report shows that just over 10% of thematic funds globally outperform at the 10-year horizon. The data for Canadian listed funds is even more damning, with 100% of Canadian listed thematic funds either closing or underperforming at the 10-year horizon, and 100% of funds closing by the 15-year mark. The underlying reasons for this poor performance are something I've gone into a lot of detail on in other videos. I'll link to them in the video description. The short version is that all the exciting growth you expect from a theme is usually already reflected in high stock prices for stocks related to that theme. As reality
Really? Wow. And the funny thing is, not many people know that. I am dealing with a bunch of low IQ morons on this channel. Seriously, I still get hate for VT. They think I'm the dumb one. They really do. And they're the ones buying this garbage. But they mock me. How dare they?
unfolds, expectations tend to settle down and stock prices tend to fall. Cannabis was a crazy extreme example. When Canada legalized cannabis, investors saw the potential for a massive market to open up, and they piled dollars into thematic funds built around that cannabis theme. At the peak, cannabis funds made up more than 60% of the Canadian thematic fund market. Today, they make up only 1.4%. The hot themes today, based on fund flows, are security and AI. I'm not saying we should expect the cannabis level bad outcome for these themes, which are obviously much different and more consequential to the broader economy, but I do think it's important to consider the long-term data on thematic investing. Despite the data, investors continue to be attracted to these products, likely due to attentional bias.
You know, I bash pensions, right? But then again, maybe we do need pensions for people, okay? Maybe we need like a national pension in the United States because people are so stupid, they don't know what to do with their investments. They are completely clueless. They need big daddy government to force them to save and put money into a pension plan that will invest stuff appropriately instead of buying thematic clown TFs, because otherwise they're just going to lose all their money. People are that stupid. Democracy, bro. Everybody should vote, bro. Yeah.
Investors are attracted to basically shiny objects, and fund managers know which objects are shiny, and optimism bias, and investors overestimate the probability of a good outcome. Also, extrapolation bias. Investors assume that recent trends, like recent past performance, will continue indefinitely. As a general,
he's right. I'm dealing with idiots. You know, even if International did like amazing for 10 years, I would get no credit. I would get zero credit. Only the clowns are, I was always in International. Whoa!
General rule, I think thematic funds belong in the pile of ETF slop, which should be avoided by most investors most of the time. If thematic ETFs play on investors' optimism and extrapolative beliefs, buffer ETFs play on their pessimism. Investors tend to overestimate the probability of negative events and also loss aversion. Investors feel the pain of losses more acutely than the joy of gains. Buffer ETFs are funds marketed as providing exposure to the stock market with some level of downside protection to smooth out the ride. I'm only picking on BMO here because they have the clearest marketing material that I could find. So great job, BMO, and apologies for picking on you. Let's take...
No, don't apologize. They're grifting. Why are you apologizing to scammers? No, you're not going hard enough, dude. Like he talks about all these disgusting, corrupt ETFs, all this slop. But he never actually says what the problem is. It's hyper-capitalistic Wall Street insane greed. That's the problem. It's evil. But he can't go that far because, you know, he's in that industry. I would be if my children went into money management, I would be disappointed.
I just want to make money so I can get my new car, bro, and get a boat, bro. Yeah, and go to Amsterdam and hang out with the girls in the red light district. Yo, I'm a party baller, bro.
Degenerates.
Take the BMO US equity buffer hedged to Canadian dollars ETF January as an example. This ETF is designed to offer the return of a US large cap equity index up to a cap of 8.1% for the period January 20th, 2025 through January 5th, 2026. While providing a buffer against the first 15% of a decrease in the market price of the index. This structure with a capped upside and a partial cap on the downside is one of the most common structures for buffer funds. Here's the BMO fund I mentioned against a BMO ETF of the underlying equity over its current target outcome period. It has clearly done its job of capping downside up to a 15% loss and capping upside at 8%. It's pretty cool financial engineering for the end user of the product if they want that very specific payoff profile. But this setup comes with some problems, as detailed in the 2025 paper.
Why would you cap your upside? Oh, people will reason themselves into total nonsense.
Rebuffed an empirical review of buffer funds. The options used to structure the payoff may be naturally too expensive, the transaction costs of trading options may be high, and the fees managers charge may be meaningfully higher than they would alternatively be in a passive allocation to the reference asset. The authors of Rebuffed show that this has become a huge category measured by assets and number of funds. They also show, consistent with my ETF Slop thesis, that the fees are high. With the BMO fund as an example, the fund has an MER of 0.73% compared to 0.09% for the reference asset. The paper shows that the vast majority of buffer funds in the sample, which includes all US listed defined outcome funds in the Morningstar database with at least 24 months of history, offer inconsistent downside protection with realized losses frequently exceeding what investors might expect based on option payoff diagrams in marketing materials, especially out.
Translation, it's hot freaking trash. If you're a long-term investor, you don't need to cap your downside. If you don't need the money in 20 years, who cares if it goes down a little bit for a year? If you need money, maybe it should be in cash. Yeah, crazy concept.
Outside the narrowly defined target outcome periods. And probably the most important finding is that simple, low-cost alternatives like mixing equities with cash generally outperform buffer funds on average and even in drawdowns.
Really? That's what I do. Yeah. Oh, it's so hard.
This raises the obvious question of whether these buffer ETFs are truly designed to serve investor goals or just to cater to their behavioral biases to sell high-fee products.
You know the answer to that, Ben. They're all grifting scum. They are evil. They provide nothing to society. They extract. They are rent seekers. They are filth. But you're in that industry, so, you gotta beat around the bush a little bit and not offend too many people. Go get a real job, bro. Okay? Go be a nurse. Go do accounting. Go be a landscaper. Go be a plumber. Go do something that actually benefits people instead of just creating these sophisticated scam products to harvest as many fees and charges as you can from people that have no idea what they're doing. Basically, helpless people. It's evil. No, it's not. It's capitalism, bro.
The authors conclude that their analysis adds to a growing body of evidence that much of the innovation in this space is superficial and engineered more for sales than for substance. I think buffer ETFs are really interesting pieces of financial engineering.
Who was the high IQ Chad that quickly exposed Yieldmax's grift? Who was that man? Oh, it was me. It was me. I remember seeing a Meet Kevin video. He did it like a year after I talked about it. He's like,
you know what? I think Yieldmax might actually be a scam.
I'm like, wow, what a genius.
Absolutely brilliant from a marketing perspective since they cater to strong investor biases that many people are willing to pay to address. I mean, who doesn't want shock absorbers in their portfolio? But I do not think they improve expected outcomes for investors. After their relatively high fees and implementation costs, they are likely to be detrimental to long-term investors in most cases. If someone thinks they need buffer ETFs in their portfolio to sleep at night, it's probably a sign they should review their asset allocation, which can be expressed using a combination of low-cost index funds.
No, you can't help them. They're small brains, okay? Big brains think long run. They think far into the future and they're strategic. That's a big brained person. Small brain people look at day to day. The market's down. It's down 2%. It's on sale. That's a small brain, okay? And there's more small brains than big brains. So if you're a big brain trying to talk to a small brain, they're going to think you're a small brain. When in reality, they're so small-brained that they don't realize that they're a small brain. Do you see how this works? Who makes all the money on YouTube? The people appealing to the small brains. Evil!
Funds or a risk-appropriate asset allocation index fund rather than adding a complex product with high fees to their portfolio. Unlike a buffer ETF, covered call ETFs and the covered call concept more generally cap upside returns without offering meaningful downside protection. They do this by selling call options on stocks held by the fund. If the underlying stocks perform well, the upside is capped. If they do poorly, there's limited downside protection from the option premium, but the downside is mostly unprotected. I did a series of 3 videos on covered calls last year, so I'm not going to go too deep here, but the important points are that these funds are designed to attract investors with their high distribution yields, which are often enormous. The funds are marketed on those high yields with branding names often including the word yield or income, but the
Yes, Yieldmax. Anybody that unironically likes Yieldmax is a fraud and doesn't know what they're looking at. The biggest example is Amit Kukrija, who said Misty was not a scam. You fool. You disgusting, insane clown. Go get a job.
The problem is that I don't think investors understand that the high distribution yield from covered call ETFs comes with a huge trade-off on the upside of returns. The total returns of covered call strategies should be expected mechanically to trail the total returns of their underlying equities. In past videos, I compared covered call funds to their underlying equities and found, as expected, that they underperform most of the time, including for investors who need income from their portfolio. As a follow-up to the many comments on one of these videos, I tested funds that viewers told me were better than the ones I looked at in my...
Somebody said he's cherry picking. Go look at the financial statements of Yieldmax. It's obvious what they're doing. Oh, wait, you don't know how to read financial statements because you're a clown. You think you're getting a huge dividend check every month. You are low IQ. Just a fact, okay? You don't like how I'm talking to you? I don't care. I don't care at all. It makes me happy to insult you because you deserve it. You arrogant clowns.
my initial video, they still look the same. Not so great relative to the underlying. I modeled an investor who needs income from their portfolio and asked if covered call funds provide an advantage over a simple combination of regular portfolio dividends that you get from owning an index fund and occasional portfolio sales to fund whatever the income need is. And I found that covered call funds leave investors worse off rather than better. I also showed that a simple combination of stocks and cash can closely match the returns of a covered call fund without putting a hard cap on upside returns. One of the things that I learned from making videos about covered calls is that this investment strategy has a cult-like following. People do not like to be told that covered calls are not printing free money.
Most people cannot. They are cults. You cannot save most people. You can save a couple people, okay? You can save a couple, and I'm proud that I've done that. But most people are cooked. Most people are just done. They will always underperform the market, and they will be poor now, 10 years from now, 20 years from now, and forever. You'll be doing pretty well with just buy and hold and reinvest dividends on your index. And guess what? When you're older, they'll just call you an evil capitalist or something, or they'll just gaslight you and still say you're poor, even though they're the ones that are poor. Like, you can't help these people. I used to get super mad about it. You just got to accept it. People can't be helped. It's just true. Okay. The amount of insanity and cult-like worship of absolute grifts and nonsense, it will melt your mind if you think about it too much. It will melt your mind. You will go insane when you're confronted with the insanity of the world.
It's another example of a huge marketing win for the ETF industry that's likely to come at a substantial cost to long-term investors buying the products.
Losers.
Single stock ETFs might be the sloppiest version of ETF slop. They're being issued in huge numbers. They have high fees. They're complex tools for speculation wrapped in an easy-to-use vehicle, and they're being marketed to retail investors. There are two main types of single stock ETFs. One focuses on positive or negative leveraged exposure to individual stocks, while the other offers income generation through...
You know Gil's seething, right? He's seething right now. And I'm smart. Why have NVIDIA when you can have 2x NVIDIA? Are you stupid? Why have 2x NVIDIA when you can have trillion X NVIDIA? It's common sense, bro. How do these sophisticated investors not understand this? I have a Robinhood app with $5,000 in it, and I know what I'm doing. Yeah, I'm going to show you, Warren Buffett, loser.
Covered calls on individual stocks, and then some combine these two attributes, leverage and covered calls. Single stock covered call ETFs come with all the same issues as covered calls more generally, with the added risk of individual stocks. They're marketed with names like yield maximizer, yield shares, and high income shares to appeal to the mental accounting bias where investors separate income and capital into different mental accounts. The problem, again, is that income
Total return. Total return. Total return.
generated by a covered call comes at the cost of upside returns. The result is, yes, a high income yield and lower expected total returns. Some providers attempt to address these lower expected returns by adding in leverage to increase expected returns. A common structure that I've seen is 25% leverage on a single stock covered call strategy. In the setup, you do have higher expected returns due to the leverage. You still have capped upside due to the covered call, and you get the more extreme downside of a leveraged position with only a little bit of cushion from the option premium.
You can't just buy the share. No, you can't do that. You got to have covered calls and then 2x leverage, bro. Oh man, I could never manage people's money. I would go insane. I would quit within a couple months. I just can't do it. I can't deal with the stupidity. In tax, there's a lot less stupidity. Okay, some people get mad maybe if they owe money. Okay, you didn't pay enough money throughout the year, but on average, most tax clients I've had are pretty good, right? They understand they owe tax or they get a refund. Common sense, right? Did you pay enough or did you not? In this industry, oh my God. No, thank you.
Plus the cost of leverage. Some of these funds have expense ratios, including the cost of leverage, well above.
The guy's name is Butt. I don't know if you saw that. His name is Nawan Butt. Oh, man.
Of 1%. Let's also not forget that you're still exposed to the risk of the individual stock. Most individual stocks have long-term returns that trail the market, and many individual stocks suffer.
What does this say? The best performing 4% of listed companies explain the net gain for the entire U.S. stock market since 1926. Just buy the best 4%, bro. It's easy, bro. Just buy the best 4%. But I beat the market this year, so I'm a genius. Yeah, okay, yeah. Lifetime total returns don't matter, bro. No, it's just, did you beat the market 1 year, bro? That's all that matters.
From large losses that they do not recover from in their lifetimes. These issues become more extreme when more leverage is employed. Leveraged single stock ETFs magnify the already high volatility of single stocks, and they come with their own unique costs. As reported by Jeff Tack from Morningstar, while traders may expect to earn 2 times the daily return of an individual stock when they purchase a 2x single stock ETF, they often get less than 2x on the upside and more than 2x on the downside due to the high cost of financing inside of these funds. These costs don't show up in an expense ratio because the leverage is often coming from swap contracts. Rather than paying interest explicitly, the financing cost is baked into the price of the contract. The result has been a significant shortfall in returns of many leveraged single stock ETFs relative to their target daily return.
Oh, Gills, he's burning up. Oh, I'm sure he's posting, angry comments. He's not happy right now.
This bid Felix guy's dumb. Yeah.
Between high costs, high volatility, and the skewness in individual stock returns, leveraged single stock ETFs face a lot of headwinds. A 2025 paper by Hendrik Bessenbinder finds that long-levered single stock ETFs issued since 2022 underperform a simple frictionless leverage benchmark by an average of 0.79% per month. That is more than 9 percentage points per year, with 0.26 percentage points attributable to the cost of daily rebalancing and 0.53 percentage points attributed to frictions like fees and the actual cost of leverage over a risk-free borrowing rate. Inverse leverage funds trail a simple benchmark by 1.01% on average, that is more than 12 percentage points per year, with 0.73 percentage points attributable to daily rebalancing and 0.27 percentage points attributable to frictions. Since the sample of live leveraged single stock ETFs is pretty small and pretty new. Bessemer simulates leveraged single stock ETFs for thousands of individual stocks going back to 1974. He finds that at a 1-year horizon, a little more than 2/3 of hypothetical 3x leveraged single stock funds underperform a simple leveraged benchmark.
Oh, I can't wait to see what happens to TQQQQ during a vicious bear market. It only takes one. It only takes one bad bear market and you're done, son. You're cooked. You're annihilated. You're exterminated. You're extinct. And then you'll just lie about it. Oh, yeah, I actually sold at the top. Yeah, okay. Okay, yeah, I'm sure you did, bro.
61% underperformed the unleveraged total market index return, and 56% have negative absolute returns at the 1-year horizon. The numbers are slightly better, but still not great for 2x leveraged hypothetical funds, and in both cases, there is a non-trivial occurrence of total losses at the 1-year horizon. Inverse funds, unsurprisingly, look much worse compared to the market. As these products began to hit the market, the SEC even issued a warning to investors. Picking individual stocks is risky enough without leverage. The last thing investors need is a tool that makes betting on or against individual stocks easier to do while charging them a premium for the privilege.
You can't save people, Ben. You can't save them. You can save, out of a group of 100, you can maybe save 2 of them. That's it.
In general, complexity in investment products is not a good thing. A 2021 paper looks at the allowance and use of derivatives, leverage, and illiquid assets by mutual funds and finds that they are associated with poor performance and higher risk. Simple, low-cost products are likely the best tools for most investors most of the time. As John Bogle, the late founder of Vanguard, said, you get what you don't pay for. Bogle also kind of called what we're seeing in the ETF market today back in 2015.
I said it. Yeah, he did do this.
2015. He said, I freely concede that the ETF is the greatest marketing innovation of the 21st century. But is the ETF a great innovation that serves investors? I strongly doubt it. In my experience, almost 64 years in the fund industry, I've learned to beware of investment products, especially when they are new, and even more when they are hot.
He was a wise man. You know, I don't like the fact that he didn't like international, but he was a wise man. He was mostly right on a lot of things. But no, what is he talking about? I bought 2x Tesla yesterday, and it went up a lot, bro. So that means that Ben Felix and Strongman and Jack Bogle are just clowns.
Bogle was concerned that while there's nothing inherently wrong with the ETF wrapper, it was being used to entice investors into exciting products intended to be traded frequently, likely to their detriment, while generating high fees for the ETF issuer. Bogle was right. We have entered the age of ETF slop.
I feel like a genius owning VT. I feel more intelligent every day owning VT. Woo! All right, let's get into the comments. I was checking on my phone. Of course, Alan and Gil were just commenting up a storm. I'm sure they had some positive things to say. Welcome to the membership, Alex Charles 3772. Don't see the difference between owning a couple of clown ETFs and owning everything like a clown with VT. So if you have like 2x inverse leverage silver, 2x long Bitcoin, and a Yieldmax fund, it's basically the same thing as VT, bro. You're a lost soul, Gil. You are a lost soul. I thought Ben Felix was right, but now that Strongman agrees with him, he's probably wrong. I love how Alan watches a guy that he thinks is wrong about everything. Is Ben Felix better bald or with hair? I like the hair. The data and the science is in. Women like hair. Hair, good. Bald, bad. I don't want to hear the coping. If you don't have hair, go get hair. That's the real question. You forgot to put the date in the market open. I don't think, honestly, I don't think I need the date. I mean, it's not a bad suggestion, but the video, it's only applicable to that date, and they can see the date I made the video on the video. So I don't know if it's absolutely necessary. You might want to consider low T treatment. Do I have too much testosterone for you? Real men want to conquer the world, not settle for 36. Yeah, that's what I said. That's what I said. I just want 36K a year forever. That's my goal, bro. Just capitalist things. I mean, I know I probably sound like a communist or a socialist, but just rationally think about what these people are doing. Do you think that's a good thing? Think about it rationally. Okay? Don't let your bias come in. Objectively look at what these ETF managers are doing. They are evil scum. I don't care if capitalism, it's evil. Correct, Alan. So far, you're doing better. Oh, thank you, Alan. You must have low expectations. Good to see you, strong man. What's up, man? How's it going? This is a terrible job. See, I knew Gil wouldn't like this video. It's too academic. I mean, he wants to see vertical lines, you know. He wants to see like stock price predictions. That's what gets him off. Get rich quick, bro. I did have very low expectations. He's not even old. He should still drive for greatness. Yep. If I make $36,001, I'm going to give everything else to charity. Buffer ETF while buffering. Simplicity, Alan. Simple-minded. Are fund of funds a scam too? Not necessarily. Like if you have a target retirement fund, I don't think that's a scam. But you got to be careful. Like if it's like a fund of Yieldmax funds, yeah, because Yieldmax is inherently a grift. Yeah, it's probably a scam. Ben Felix Bogle has pretended to is charging for his financial hefty fee, so you pretend to be charging for his financial services. Yeah, I mean, at the end of the day, Ben Felix is a quasi-grifter because I don't even think you need a financial advisor. You don't need a financial advisor. Unless, the only time you do is if you're just a impulsive small brain. If you're a small brain, okay, maybe you need a financial advisor. If you don't have control of your emotions because you're feminine, okay, maybe you need a financial advisor. If you're rational and level-headed and masculine, you probably don't need a financial advisor. Is it just me or is this boring content? Of course it's boring to you, Gil. Of course. You think you want to read stuff like academic research? No, that's not your vibe, bro. Strongman is better off reacting to current events to build his channel like as... Oh, you mean like the market open and the market close? Him watching Trump earlier was good. It's not bad, but judging by the viewership, most aren't interested. You'd be surprised. Sometimes you do a live stream and you get like no views on the live stream, but you get a lot of views over time. Like I've had that happen many times before. I mean, this video could bomb. Okay, whatever. But sometimes like over time, they actually do get a lot of views. You'd be surprised. Like that Edward Jones video I did. I had like maybe 5 viewers, 10 viewers when I did it. And now it has like 27,000 views. And it's maybe like $250. Monish Prabrai did the exact same thing. Strongman, he just copied Warren Buffett's investments. Yep, copy Warren Buffett, bro. Not bad, but boring is the word I use. And judging by the viewers, people find this boring. Oh, you know, I agree. Most people want excitement. Oh, vertical lines. Oh, I don't believe in that. I think that's wrong. His firm actually charges a lot. I wouldn't be surprised. Yeah, you don't need Ben Felix. I mean, he's intelligent. But at the end of the day, you know, he always talks about index funds and stuff. Okay, then why do I need you as a financial advisor? I don't need you. And then, of course, he has the factor tilts thing he likes. Why? To add complexity. Why does he want to add complexity? To convince you to pay him. Strawman gets views when he attacks grifters, not agreeing with a video like this. Good point. Doesn't Ben charge for financial advice? I guess Strongman approves. I don't approve of that. Ben fearmonger sometimes. Like last year, he was predicting that market is facing underperformance for a long time. An average investor needs to be careful. I mean, it's possible. We could have underperformance in the future. My advice is just dollar cost average. Hold, reinvest dividends. Sometimes stocks go up a lot. Sometimes they don't. But you're accumulating more and more and more of the world's productive assets. That's the goal. Good thing we're in the comments. Strongman funnels his audience to cash flow kings. Yeah, I shill cash flow kings every second of every day. Volatile stock picking and paid discords and hedge funds. He will approve anything. Yes, Alan. Except making money. Don't forget, Strongman heavily endorsed everything money. I did back in the day because they were like one of the few kind of like semi-rational voices. But over time, I figured out they were wrong, and I changed my mind on them. But I'll admit it, yeah, initially, I did endorse them. But I have since retracted that endorsement. But you can hold it against me forever. I was wrong. Trudy likes to portray himself as a good guy. We know better. It was only once he realized Paul would not want to work with him at all because he's unprofessional. Yeah, oh yeah, that's the reason. Yeah, that's the reason, bro. Everything money is another crap. I don't get if Strongman likes those two morons. People forgot he interviewed Seth and was trying to fluff Paul. Morons. I would trust Jeremy more than Kevin. Gil, there's something wrong with your head. Okay? You're just delegitimizing yourself constantly. Kevin hires you, will promise you a career. Then he flip-flops on a new idea and fires all the works he bragged about paying good. You don't think Jeremy axed half his freaking employees after Financial Fortress collapsed? On the irony, do something productive like being a live streamer I'm just a live streamer, bro. I don't do anything else except live streams. Yeah, just say things that are patently false. Just say it, bro. Alan is an anti-VT warrior. Oh, he loves me. Coach is a scam POS who pumped Yieldmax fund manager Jada. He did, and now he's paying the price for it in the Discord. Ooh, not pretty. We got your same drift already for days already. You point taken, master. Oh, mister, is he talking about how VT's bad? Okay, yeah. All the slop ETFs are good. VT is bad. I buy VT on tops and bottoms. Exactly. It's called dollar cost average. I'm actually laughing at you, not seething. I'm laughing because you think this is good content. Gil, this is not your type of content. Okay? You're like a child. You're like a cat following a laser. You just jump from like shiny thing to shiny thing. You're like jumping and following the laser. That's your investment strategy. You use numerology. Gil, I'm the smart one here, okay? I'm the rational one here. You are not. But of course, the audience, well, numerology is better because VT didn't go up a lot compared to random stock. So I'm going to follow Gil and 2x inverse leverage silver and do numerology. This is drag. Oh, now it's not going fast enough. Oh, be faster. Talk faster. I'm talking faster. Is this better now? Is this better now? Oh, I'm talking faster. Oh. This could have been covered in 15 minutes. And yet you're still here commenting. Interesting. Along with another topic. Oh, you're trying to help. Just like a woman constantly nitpicking every single minor detail. You just have to say something. True. There's a reason Amit and Meet Kevin are quick. They know how to keep up pace. Dan Weston had an even more terrible pace. Like I said, he might need low T treatment. No surprise, YouTube. Majority of people aren't smart because they look on market prices in their portfolios. Only small minority look at the amount of shares they've accumulated for decades. People are small brains, bro. There's not many big brains out there. And if you're a big brain trying to talk to a bunch of small brains, you're just going to get hate, okay? This is going to put me to sleep, but he's still watching. Felix is boring. He's boring. I want excitement. I'm a girl. Can't believe Strongman said he can't stand Jeremy, but could stand this. Oh, my God, Gil. Comments where the entertainment is. Well, that is part of the entertainment. Of course it is. Ben Felix aiming in high net worth clueless public, so he talks boring, but he knows how to grift his high price services. Yeah, he does have a grift going on. Gil, truce is over. You brought this on yourself. You are lying POS. You flip-flop trash market calls every day. Gil, you need to debate Dan. You are embarrassing yourself. Okay? Gil, you are embarrassing yourself. You flip-flop every day. You use numerology. You won't debate like anybody like a man. You're being a chick. Come on this channel or go on Dan's channel. Debate them live. Let's do it. I'm only down 13%. You are a trash troll, Gil, liar. You don't have anything right. You just see women up and claim victory. When is your Stake or DraftKings sponsorship coming? Never. Let's see. Multiple trades he lost 30 to 40% on. Oh, man. We need to be able to buy VT futures. Yeah. We should have like a sports betting. Will VT go up or down today? We can like bet on that on Robinhood. Oh, man. Wow. Another abusive live stream for the comments. I just get nothing. You see, guys? I just get nothing but hate. Okay? This is why people don't want to do good in the world, because when you try to use your big brain and you talk to small brains, they just attack you for it. You know, and after a certain amount of time, it's like, if you keep trying to help people and they keep spitting in your face, you're not going to want to help people anymore. But I still do it, you know, because it's my mission. It's my mission. It gives me fire. It gives me motivation. Woo! What stream is next? Okay, the market close. That's free money since VT only goes down. Oh, that's funny. All right, like, subscribe. Consider joining as a member to support the channel. Also, consider booking a free, and I mean free, 30-minute tax consultation with me. I am a certified public accountant and would gladly do your business and or personal taxes any state in the United States. You can talk to me for free. I give you upfront fixed quotes, and I'll do your taxes like a boss. You can book a free 30-minute consultation with me by clicking the link in the pinned comment below. I actually have 2 tax consultations tonight, and then I'm hanging out with a friend. So, unfortunately, I don't think we're going to have the e-begging stream tonight.
Oh my God, bro. He's already giving up, bro. US tax, bro. US tax, bro.
All right, talk to you later. Cheers.